it's definitely an interesting time. I mean, that you're seeing a lot more creativity. You're seeing a lot of even professional fund managers move into the space where historically it was you know, a lot of these original funds were led by litigators, by former litigators that had spun out of big law. So some of them, I think you are seeing more institutional capital start to move into the space because it has inherent characteristics that are attractive. It's uncorrelated or even inversely correlated to the broader markets, and historically, it's been very hard to access. Um, so now these new structures really create an entry point for more institutional capital to help the market grow.
So I think if you dial back, call it a half decade, from my perspective, that was a really interesting time. That was when you saw a lot of the conventional asset managers who may have found there to be an ick factor 10 or 15 years ago. You saw them to move in, and you also had you had low interest rates, right? So you had credit investors sitting there figuring out how do I chase that spread, and if I can get 18 or 20% on a mass tort loan or a PI, a loan to a PI law firm, that was a very, very attractive opportunity. Or to buy a sliver for, and hopefully chase 16 or 18 or 20%, that was great. We are in a slightly different place several years later. Ben, your finger's probably on the pulse better than anybody on this. How have interest rate hikes impacted the appetite for institutional investors to invest in litigation finance?
Yeah, it's there are multiple answers to a very good question, Evan. I think if you segment the market itself between more credit-like products and more equity-like products, I mean, there's certainly an area of the market, pre-settlement advances, for example, where you're
Right.
funding advances in anticipation of settlements, mostly on motor vehicle claims or other personal injury claims. That's a market that's evolved to the point where there are bank warehouse capacity available, there are rated securitizations that have been done. And so there's a very direct impact on the increase in interest rates because that's a business that funds itself in the capital markets on a floating to fixed rate basis once there's a takeout done. So certainly a direct impact. As you look at the folks that invest in the space, the more multi-strat funds that we were talking about earlier that might be looking at a judgment preservation policy loan or otherwise, I think there's certainly more price sensitivity versus what's the relative value of my capital in this market where I'm taking some duration risk, maybe I'm not getting current cash pay, it's not perhaps that liquid, it's got a little wonkiness, you really got to roll up your sleeves and understand it, and it's not scalable like buying CLOs is scalable. So there's some premium there, but there's some premium to what else I could be doing. So I think you certainly see an impact there. On the single case funding side, Josh may have a better perspective than I do there. I feel like litigation funders that have raised dedicated litigation funds with targeted absolute returns that are more multiple based, maybe an IRR overlay, less sensitivity, I imagine, in that world, given that it's more of an absolute return
Hmm.
and candidly, the returns that are generated in that space, I think we view as a great diversifier for us and not that sensitive or not sensitive really at all to interest rate movements or macroeconomic trends and so on. And so we view that area as more of an absolute return strategy as opposed to a relative return strategy and more of the credit products.
Yeah, I think that's exactly right. I think the absolute and relative distinction is correct. And I think for some of the products that inherently look more credit like, you will start to see, or you're probably already seeing certain provisions in there that allow, have the rates move based on underlying movements in the market. Some of the deals may not get done, but I think more likely they'll get done with appropriate protections for the investor so
Hmm.
that the returns kind of keep in line with the expectations made during underwriting. On the single case side, I agree that that's just an absolute return profile, and it's really not going to be sensitive to those kinds of movements. To the degree it's indirectly sensitive, it's when the litigation funder is trying to raise capital and
Mm.
lay out the different components of their asset allocation strategy. And investors have a lot of alternatives in this market.
Yeah, and perhaps nuance point, but one we do focus on in more of these credit products, especially where there's a heavy PIK component to
Yeah.
the rate, which is common. Obviously, higher PIK rates mean higher return, but you don't necessarily have an appreciating asset that you're financing. If you're
Right.
financing a judgment preservation policy, the policy is as big as the policy is. And so the more interest you're picking and adding to your balance, you have to think about that as you think about how much you're willing to lend up front and what appropriate LTVs are given the extension and duration risk in the market, which has just been incredibly difficult for even the best minds in the space to underwrite correctly.
One one other thing I would add that I just think is really interesting. I think we're at a point now where there is creativity. There are novel deal structures that are being um, conceived and implemented. And I also think it's worth mentioning the impact of data and the impact that's going to have going forward. Because what's happening now, in my view, is there are sophisticated parties, whether they're investors, insurers, others. They're doing these deals, and then simultaneously they're also building their own data sets
Hmm.
around these deals. And a lot of the data that you would take for granted in a private credit context, some of it doesn't exist. It's incomplete. It doesn't exist. It needs to be created. So I think the next wave of really successful investors in this space, I think, are going to have some component in their strategy where they've developed valuable data sets, proprietary data sets on their own, where they really, I don't necessarily mean um, massive quantities of data, but they're going to have real specific insights that are informed by particular deals they've done. And like I said, I do get the sense that people are creating that data themselves at this point, because a lot of it doesn't exist and it's certainly not readily available.
Yeah, for
Which,
sure. Look,
yeah, go ahead.
one thing that I find um, challenging, right? I mean, you could have, you could certainly have case data, right? That's been out there for some time, Lex Machina, lots of data sets on personal injury litigation or on patent litigation, Josh, in your space, or yada, yada, yada. Um, but there's not a ton of data on the actual performance of some of these underlying law firm loans, for example. And then there's a whole separate thing of how do these things work out at the end of the day? This isn't like lending to a schmata business, right? Where you can go foreclose on whatever collateral is sitting in a warehouse somewhere. These are lawsuits that inherently go with the lawyer from place to place. That's what I like to call, the elevator industry, right? It relies on somebody getting in the elevator in the morning and actually going to work. So it's not as though we can even get data out of like bankruptcy dockets, for example, to see how these loans ultimately work out. I mean, what kind of challenges does that uh, inability to haircut that risk? What challenges does that present from your guys' perspective?
I think there's a really interesting conversation to have about data broadly, returns in particular, technology that goes along with that as well. I mean, I think that, I mean, make no mistake, the investors that are doing these deals have done robust underwriting. They have target returns. They monitor those investments carefully and closely, and adjust their expectations as the investments progress. I guess when I was talking about data, what I was kind of alluding to was it's the data that you're going to rely on, you typically have to create yourself, as opposed to in a lot of situations for other asset classes, you can look to benchmarks or other more semi-public
Right.
information. And I think we're at a point where um, large sophisticated investors have made the business case to invest in these kind of credit structures that are now moving into litigation funding. And there's certainly good good reasons why that business case makes sense. And I think now we're at a point where these investments are monetizing and generating returns, and that those insights are flowing back into their data set that they're building.
Hmm.
But I think it's going to require some creativity on the data side and the technology side, and that creativity includes not overestimating what 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 you can and can't do. I mean, like, so when we think about technology, for example, as an aside, like, we're not talking about AI reading reading briefs and interpreting them. Now that's perfectly fine for that to happen in parallel, and you can see how they compare to the experts. But when we talk about technology from a practical standpoint, like, we're really talking about, are there ways to streamline the process and pull the friction out of a lot of work that ultimately isn't hugely value added?
Right.
And then that frees up the value added resources to do more important things. So
Hmm.
that's how we tend to think about it.
Yeah, that makes sense, Josh. I think there's certainly, areas of the market where, especially areas again like, pre-settlement advances where they're homogeneous assets and
Right.
large
Correct.
numbers of them where, the data angle is perhaps, more obvious. I think, you're right, Jay. It's difficult, outside looking in. Even if you know the result of a case that was funded, it doesn't
Right.
necessarily mean the result. Was it a good financial outcome for the funder? And so,
Absolutely.
um, certainly as the industry continues to mature, the folks that have been doing it for some time are developing their own, track records and learnings of success. But to your point, Josh, a lot of that is proprietary, based on, individual experience, not some market data set that you can get your hands on, which I think in a way, creates some barriers to entry,
Exactly.
as the industry, has evolved.
So Ben, you're in the best position to, I think, evaluate this as well. When, uh, certainly you don't spend your full day working on just litigation finance. What other asset classes are you looking at? How are they similar, or how have they somehow led to the footprint in the litigation finance space? And what are ways that, presumably some of those asset classes are a little bit more evolved in terms of data or track record, that make them a little bit more investable?
Yeah, so as we think about portfolio construction, if you will, within our asset opportunity strategy, we do a fair amount of investing in uncorrelated, more esoteric areas of the market, and it really does require rolling up your sleeves, understanding the asset, but we like having a portion of our portfolio that's relatively insulated from what's going on with macro conditions. And then the other asset classes that we invest in, like consumer credit or corporate credit, that are more kind of on the run, and have more liquidity or perceived liquidity associated with them. We tend to be more opportunistic, and we'll invest at times when we find the return to be compelling, and pull back when we find it to be less compelling. And so as I look at the kind of more esoteric asset classes that we've invested in, there's no great comp, but the best comp I can come up with is the life settlement space, where an
Right.
investor will purchase a life insurance policy, pay premiums over time, and collect an insurance benefit at some unknown point in the future. And so, at least from a cash flow perspective, there's some similarity to funding a case, and that money can drip in over time. And then there's some, uncertainty as to the duration of the ultimate resolution. And that's a difficult profile for a lot of investors. And I think the flexibility of our capital allows us to invest into structures that or at least underlying assets that have that profile. But that's not a standard credit profile. Typically, you're making an investment in a loan and you're getting payments quarterly and some amortization along the way, and maybe a bullet at the end. And so, I think, much like the, life settlement space, for example, it does create some barriers to folks in investing in it. And then kind of within litigation finances, we've kind of segmented the market between more kind of debt and more, equity like products. I think, certainly as you look at, more of the kind of liquid credit products, as spreads widened, last year and just base rates have gone up, there definitely is a relative value, assessment. And, we've seen some interesting opportunities, on the corporate credit side, that, just at, rates and spreads that have been, unavailable, at, any time in the last, 5 or so years. And so you've definitely seen kind of more broadly an interest in private credit. But this is certainly a niche within private credit where, I still think you can earn, some excess return, but it's not nearly as scalable, and it takes some real some it takes some work, to really underwrite and pull these deals together. It's not as easy as, kind of calling a bank trading desk and agreeing to a price over the phone and settling shortly thereafter.
Yeah, I would just add that, I didn't, I actually, until joining Finitive, I didn't even realize that I had unknowingly spent the vast majority of my time in the equity world. I didn't
Yeah.
intuitively think that I was just seeing a portion. Like, I didn't fully appreciate the magnitude and diversity of the private credit space, and how those funds differ from the equity space. And I think litigation funding is, I think it seems to be just one example of many where you're seeing private credit kind of eat, you know, creep into places where you would normally just see equity investors. I mean, and all you have to do is think about asset-based lending and just think about the broadest definition of the A. We're seeing intellectual property, tech and IP rich startups, as opposed to getting equity and taking on dilution and the cost of that funding. They're trying to harness their intellectual property as an asset in an ABL type transaction. So I think you're seeing a level of kind of creativity and growth in private credit across a number of areas that historically were just completely covered by equity solutions, and litigation funding is just one of those examples.
Yeah, it's a good point, Josh, and it's something we're very mindful of because I think there's certainly, applications, an intellectual property, which you mentioned, an IP-rich business leveraging its IP, perhaps with an insurance solution, perhaps without, to get a
Yeah,
loan as opposed to equity. And that's certainly, there are credit solutions to that
exactly.
need. I'm very mindful of taking those credit solutions and putting them into scenarios that are really equity risk scenarios. So Evan, to your point around this is an elevator business and lawyers can leave, it's very different to lend to a company on the basis of the value of its IP. Maybe there's some ongoing enforcement campaign, maybe there's not. That's a very different setup than, lending, or, structuring a loan against, a business that's a law firm, but where there's, single person risk. And if the
Right.
partner decides, I don't want to do this anymore, Josh, you mentioned the asset. Well, having IP as an asset is, very different than
Yeah.
having an asset where, good luck trying to foreclose and realize, the value that you expected as part of a foreclosure. As a non-lawyer can't, take over the case. And so
Yeah.
that's obviously, not a position that you want to be in, when you went into the deal, with the expectation that you were going to earn lending like returns, not equity like returns.
Yeah, I would just add, I mean, I agree with that entirely. And these are tools that are kind of available or newly available, and they need to be used really carefully. But I do think if you think about like a Venn diagram, I do think that, guys like Ben, guys like me, I feel, lucky to be, we're operating at this intersection of a lot of these different markets. And there's a lot of room for creativity in that kind of scenario. So you have intellectual property, you have private credit, you have insurance, you have the legal markets, you have the capital markets. So I mean, there's a lot of creativity there. And I see kind of sustained growth. There's a lot of indications that we're onto something interesting, and that will continue.
Well, that's a great place to wrap up today's conversation. Look, there's going to be a ton of innovation in litigation finance space. Couldn't have had two better people on the show today. Ben, obviously, thank you for bringing a ton of knowledge with respect to the credit markets. Josh, on the forefront of intellectual property and patent space, which has always been a hotbed of litigation finance, but seems to be truly on the forefront of some of this newer innovation. So thank you guys so much for joining. Thank you, viewers, for paying attention today. Hopefully learning something, and catch you on the next episode. Thank you.
Thanks. Take care. Bye.